Just weeks ago, Microsoft looked unstoppable. The company stood at the center of the AI revolution, its stock reached new highs, and Wall Street couldn't seem to get enough. Then, almost overnight, sentiment changed. The stock pulled back. Microsoft announced another round of layoffs. And investors began asking a very different question. Has anything actually changed? Or is Wall Street simply demanding proof that Microsoft's massive AI investments can generate the returns it has already priced in? In this research, we'll separate market sentiment from business fundamentals, and examine whether Microsoft's long-term AI investment thesis remains intact. Over the past 3 weeks, Microsoft has faced a noticeable shift in market sentiment. After reaching new highs, the stock experienced a meaningful pullback. During the same period, the company announced approximately 4,800 job cuts across several business units as part of an organizational restructuring. At the same time, investors remained focused on Microsoft's continued investment in AI infrastructure and cloud capacity. These developments did not occur in isolation, but together they prompted the market to reassess expectations for one of the world's most valuable companies. But here's the important question. Did Microsoft's business actually change, or did investors simply change their expectations? At first glance, Microsoft's pullback may appear to signal a weakening business. But the available evidence suggests something different. Over the past 3 weeks, there has been no announcement indicating a material deterioration in Microsoft's core operations, competitive position, or long-term strategy. Instead, the market appears to be reassessing expectations. After a powerful AI-driven rally, investors are asking a tougher question: can Microsoft's future earnings justify the premium valuation the stock has already achieved? In other words, the debate has shifted from whether Microsoft is a great business to how much investors should be willing to pay for that business today. So what exactly caused investors to become more cautious? The answer begins with one of the biggest debates in the technology sector today: AI investment. Microsoft's commitment to artificial intelligence has never been stronger. The company continues investing aggressively in AI infrastructure, expanding data centers, increasing cloud capacity, and integrating AI across its product portfolio. Management has consistently stated that these investments are necessary to meet growing demand for AI services. But as capital spending continues to rise, investors are becoming more focused on one question: how quickly can these investments translate into higher revenue, stronger cash flow, and sustainable earnings growth? The discussion is no longer about whether Microsoft should invest in AI. It's about when those investments will begin generating measurable financial returns. That brings us to an important shift in investor behavior. Wall Street is no longer rewarding AI spending alone, it wants evidence that AI is creating real economic value. Over the past 2 years, simply leading the AI race was enough to earn a premium valuation. Today, the market's expectations have evolved. Investors are no longer asking whether Microsoft has a compelling AI strategy; they already know it does. Instead, they want measurable evidence that AI is creating economic value. That means stronger cloud revenue, broader Copilot adoption, expanding operating income, and durable free cash flow. In today's market, AI leadership is no longer judged by innovation alone. It is increasingly judged by financial results. Which leads to the next question. If investor expectations have changed, has Microsoft's underlying business changed as well? Despite the recent pullback, there has been no material announcement suggesting that Microsoft's core business has fundamentally changed. The company continues to operate one of the world's largest cloud platforms, maintain its leadership in enterprise software, and expand AI capabilities across products such as Microsoft 365, Azure, GitHub, and Copilot. Recent headlines have been dominated by workforce restructuring and AI investment, but neither of those developments, by themselves, indicates a deterioration in Microsoft's competitive position. At this stage, the evidence points to a reassessment of market expectations, not a breakdown in business fundamentals. But a strong business is only as durable as its competitive advantages. So what continues to protect Microsoft's position in an increasingly competitive AI market? Microsoft's competitive advantage extends far beyond artificial intelligence. The company has built one of the world's most deeply integrated enterprise ecosystems, connecting Windows, Microsoft 365, Azure, GitHub, Dynamics 365, LinkedIn, and security solutions across millions of organizations. Rather than offering AI as a standalone product, Microsoft is embedding AI capabilities into platforms that customers already rely on every day. This strategy strengthens switching costs, deepens customer relationships, and creates additional opportunities to monetize AI across its existing installed base. But if Microsoft's competitive position remains largely intact, why did the company announce thousands of job cuts? To answer that, we need to look beyond the headlines. Microsoft's recent workforce reduction attracted significant attention, but the announcement should be viewed in the broader context of the company's long-term strategy. The restructuring primarily affected selected business units, including parts of the sales organization and Xbox, while Microsoft continues to invest heavily in AI infrastructure, cloud capacity, and engineering talent. Rather than signaling a retreat from growth, the company appears to be reallocating resources toward its highest strategic priorities. For investors, the more important question is not how many jobs were eliminated, but whether those investments ultimately improve Microsoft's long-term economic performance. And that brings us to the single most important question in this entire investment thesis. Can Microsoft's AI investments generate returns that justify the scale of capital being deployed? Microsoft has already demonstrated that it can build world-class AI infrastructure. It has the cloud platform, the enterprise customer base, and the financial resources to invest at an extraordinary scale. But none of those achievements automatically guarantee attractive shareholder returns. Today, Wall Street is asking a more demanding question. Can Microsoft's unprecedented investment in AI generate enough incremental revenue, operating profit, and free cash flow to justify the capital being deployed? That question, not the recent pullback, is now at the center of Microsoft's investment thesis. To answer that question, investors are no longer looking at AI announcements. They're looking for measurable financial outcomes. For investors, AI leadership alone is no longer enough. The market is now looking for measurable financial outcomes. That includes stronger Azure growth, broader enterprise adoption of Microsoft 365 Copilot, sustained operating margin performance despite elevated capital spending, and the ability to generate durable free cash flow as AI investments scale. These are the metrics that will determine whether Microsoft's AI strategy creates lasting shareholder value. In the coming quarters, financial execution, not AI headlines, will become the primary measure of success. But there's one important point investors should keep in mind. The return on AI infrastructure is unlikely to be measured in a single quarter. Microsoft's AI strategy represents one of the largest long-term investment programs in the company's history. Projects of this scale are not evaluated by a single earnings report or a short-term move in the stock price. Instead, investors will be looking for consistent evidence that higher AI spending is translating into stronger revenue growth, healthy margins, durable free cash flow, and improving returns over time. Until that evidence becomes clearer, the market is likely to remain focused on execution rather than expectations. So after separating headlines from fundamentals, what should investors focus on next? Looking ahead, the focus will likely shift from AI announcements to measurable business performance. Investors will be watching whether Azure continues to deliver strong cloud growth, how rapidly Microsoft expands enterprise adoption of Copilot, whether operating margins remain resilient despite elevated AI spending, and if free cash flow continues to support long-term capital investment. Together, these indicators will provide a clearer picture of whether Microsoft's AI strategy is translating into sustainable business results. Ultimately, every investment comes down to one question. Has Microsoft's long-term investment thesis actually changed? Microsoft's recent correction has undoubtedly changed market sentiment. But based on the facts available today, it has not fundamentally changed the company's business model, competitive position, or long-term AI strategy. The real question now is whether Microsoft's unprecedented investment in artificial intelligence can generate durable economic returns over the years ahead. That is the question Wall Street will continue to test, not through headlines, but through future earnings, cash flow, and execution. And ultimately, that may determine the next chapter of Microsoft's investment story. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.